You've probably pictured it like this: some company pours a few $billions into a giant warehouse full of blinking servers, rents out the computing power to AI labs, and the money starts flowing in. Simple infrastructure play. Build it, plug it in, collect rent forever, like owning a very expensive apartment building. That picture is wrong in almost every important way. Not because data centers aren't profitable, some are. But because the entire economic engine underneath the AI boom runs on a structure most people never see: assets that lose value faster than almost anything ever built at this scale, revenue that often comes from the same companies supplying the equipment, and a debt load large enough that a handful of contracts falling through could ripple across the entire industry. Understanding how that works tells you more about the AI boom than any chip benchmark ever could. Start with what you're actually buying when you build a data center for AI. A few years ago, that meant land, concrete, and cooling systems, a real estate project with computers inside it. Research from Epic AI put together one of the most detailed cost breakdowns available, modeling a 1 gigawatt AI campus big enough to power a mid-sized city at roughly $38 billion in upfront capital. Here's the part that surprises people: the building itself is a minority of that cost. Servers. The racks of GPUs account for around 60% of the lifetime cost of the whole facility. You're not really investing in a building. You're investing in a fleet of chips that happens to need a building around it. That distinction changes everything about how the economics behave, because buildings and chips age completely differently. A data center shell can last 20, 30, even 50 years. A cutting-edge GPU is often considered outdated within 2 to 3 years, sometimes faster. NVIDIA's release cycle doesn't wait for anyone. A facility optimized for one generation of chips can become suboptimal within months of a new architecture shipping. So the asset that makes up most of the cost is also the asset that depreciates the fastest. Which means the accounting reality of owning an AI data center looks less like owning a skyscraper and more like owning a fleet of delivery trucks that need replacing every couple of years, except each truck costs tens of thousands of dollars and there are tens of thousands of them. That single fact is why depreciation has become the number everyone in this industry is quietly obsessed with. Industry-wide estimates put AI-related depreciation costs at around $21 billion in a single recent quarter, and for the first time, in back-to-back quarters, global AI sales edged past that number, according to research firm Exponential View. That sounds like validation: the revenue is finally outrunning the write-downs. But look closer and the picture gets shakier. Depreciation alone was consuming more than 2/3 of that revenue, leaving a thin margin to cover everything else. Electricity, staff, interest on debt. The industry isn't printing money. It's barely clearing the bar, and the bar keeps rising as more capacity comes online. Then there's the constraint almost nobody outside the industry thinks about: power. You'd assume the bottleneck on building more AI capacity is chip supply. Increasingly, it isn't. It's electricity. A gigawatt-scale AI campus needs the same order of power as a mid-sized city, delivered reliably, with industrial cooling running around the clock because these chips generate enormous heat packed into small spaces. Getting that much power to one site, securing the grid connection, sometimes building dedicated generation behind the meter, has become the primary delay on new capacity, ahead of construction and even ahead of chip delivery. Site selection for these campuses increasingly starts with a question that has nothing to do with technology: where can we actually get the electricity? Now here's where the picture stops looking like infrastructure and starts looking like something closer to financial engineering. Ask a simple question: who is actually paying for all this? The obvious answer is AI companies, from their revenue. But a lot of that revenue doesn't originate from outside customers in the way you'd assume. It originates from the same companies supplying the equipment. Here's the loop, and it's worth following it step by step because each link explains the next. NVIDIA invests billions directly into OpenAI, reportedly committing as much as $100 billion in backing, alongside a separate $30 billion contribution to a funding round. OpenAI, in turn, commits hundreds of billions of dollars in cloud contracts to providers like Oracle and Microsoft to actually run its models. Those providers then turn around and spend enormous sums buying, you guessed it, NVIDIA chips to build the capacity they promised. The same capital effectively travels in a circle, showing up as revenue for multiple companies along the way. Analysts now estimate arrangements like this exceed $800 billion across the industry. Critics have compared it to vendor financing patterns from the dot-com era, when companies bought each other's products to make demand look larger and more independent than it actually was. That comparison matters because of what happened next in one very visible case. Oracle became the clearest example of what's actually at stake in this loop. Oracle arrived late to cloud infrastructure and needed to compress roughly a decade of build-out into a few years to compete for AI workloads. And unlike some rivals funding expansion out of existing cash flow, Oracle chose to do it largely with borrowed money. By early 2026, the company was carrying around $100 billion in debt, with plans to raise another $50 billion, plus close to $250 billion in long-term data center leasing commitments stretching 15 to 20 years into the future, commitments it's counting on subleasing to recover the cost sooner. For a while, that bet looked fine. Oracle's central customer, OpenAI, was expanding rapidly, and the flagship Stargate data center project, a joint effort involving OpenAI, Oracle, and SoftBank, became the symbol of the entire AI infrastructure boom. Then, in early 2026, reports surfaced that OpenAI was pulling back from expanding that partnership, reportedly wanting next-generation NVIDIA chips at different sites instead. Around the same time, word spread that NVIDIA's expected $100 billion investment into OpenAI might come in smaller than markets had assumed. Oracle's stock dropped before markets even opened. The fear wasn't really about one contract. It was the realization that Oracle had borrowed heavily to build facilities for a single customer whose own funding was suddenly in question. And if that customer's revenue didn't materialize, Oracle would still owe the debt, with buildings full of chips that might already be outdated by the time new tenants were found. Oracle issued a statement insisting the situation had zero impact on its relationship with OpenAI. The stock stayed shaky anyway, because the statement didn't answer the real question investors were asking: who actually pays if demand stalls? That's the mechanism at the heart of this entire industry. It isn't fraud, and analysts are careful to point that out. This kind of vendor financing has bootstrapped genuine industries before, from railroads to telecom. The AI demand underneath may well be real. But the structure means the health of one company is quietly tied to the health of 2 or 3 others in the same loop, and none of them fully control the outcome. OpenAI itself is reportedly on track to lose around $14 billion in 2026, nearly triple its prior year's losses, while simultaneously projecting far larger revenue years down the line. If that projected growth arrives on schedule, the debts get repaid, the leases get filled, and the loop holds. If it slips even by a year, the pressure doesn't stay contained to one company. It moves through the chain, because the chain is the whole point. So compare the 3 futures actually on the table. In the optimistic case, AI usage keeps compounding: more enterprises, more developers, more everyday consumers paying real money for AI services, and today's revenue eventually catches up to and then exceeds the depreciation curve with room to spare, turning today's leverage into tomorrow's cash-generating infrastructure, the way earlier waves of railroad and telecom overbuilding eventually did. In the realistic middle case, growth continues but unevenly, margins stay thin for years, and some companies in the loop have to refinance, restructure leases, or sell capacity at a discount, without the whole system collapsing. In the negative case, demand growth slows meaningfully before the debt comes due, 1 or 2 heavily leveraged players can't cover their commitments, and the circular nature of the financing means the strain doesn't stay isolated. It shows up simultaneously in stock prices, credit spreads, and half-finished construction sites across several companies at once. So what does owning an AI data center actually mean, once you strip away the image of a warehouse full of rented compute? It means owning a rapidly depreciating fleet of hardware, financed by debt and vendor commitments, whose value depends entirely on a demand curve that has to keep climbing at a pace few industries have ever sustained for long. The buildings are almost incidental. The real bet is on whether the world's appetite for AI keeps growing exactly as fast as the industry has already promised its lenders it will. Which raises the question nobody in this trillion-dollar race seems to want to answer out loud: if AI demand grows quickly, but not quite as quickly as the debt assumes it will, not a collapse, just a slower curve, who ends up holding the bill first?